Hello again, WSU Vancouver VITA volunteers. This is our Business Income Part 2 lesson. And just a reminder, this is an advanced topic, so this lesson assumes that you have already been through all of the basic training lessons. And this lesson also assumes that you have already watched the Business Income Part 1 lesson, where we covered some of the basics about what business income is, who are self-employed individuals. We kind of gave a very high-level overview of the Schedule C and how it flows onto the return, and then we talked pretty extensively about what kinds of Schedule C returns are in scope or out of scope for the VITA program. So in this lesson, we're going to continue on. We're going to delve a little deeper into the Schedule C and look at its parts in depth. We're going to discuss the kinds of business expenses that we can help our clients with. And then we're going to talk a little bit about record keeping and what to do if a client comes in and they haven't been keeping records, and how we might be able to assist them in Reconstruction or help them know how to get their records reconstructed. So before we really dig in, we're just going to take a zoomed out view of the Schedule C and look at its parts and how they fit together. This is very similar to what we did in the Filing Basics lesson in the basic course, where we just kind of took this overview to see, the different parts. So our Schedule C, on the front page here, it has the top section is for general information about the business and the way that the accounting is being done for that business. Part 1 is for income. So that's where we pull together all of the in sources of monies. And then Part 2 is the expense section. And Part 3 are some calculations. There's the business use of home and some check boxes for if our taxpayer were to have come to a loss, which, by the way, is out of scope for us. So then the second page begins with the cost of goods sold. And again, here's another section that for the VITA program is out of scope, but that's if a business had inventory, they were selling goods. And then we have Part 4 is for vehicle information, if there's business use of a vehicle and the taxpayer wants to take the standard mileage rate. And then there's Part 5, which is just some other expenses, which we'll get into that a little bit more in a few slides. So now here's our closer look, and we're taking that very top section. So again, this is general information about the business. For a lot of our VITA clients, they aren't really operating under a separate business name than themselves. They might not have an employer identification number. They're just essentially operating as themselves, which is totally fine. When we enter this into TaxSlayer, we actually really just don't enter anything into TaxSlayer. You'll notice that the fields say if the same as the taxpayer, leave blank. We do, however, need to provide some idea of what this business is doing. So you'll be typing in, what is the principal business or profession that is that this business is engaging in, and then there's this code. It's a special code for business activity, business or professional activities. And there's a couple of ways that you can find out what code is this type of business going to have. First of all, TaxSlayer on the Schedule C input screen it's the basic information input screen, has a little link or button that you push and it pulls up a window, and you can search based on some keywords, or you can scroll down until you find the appropriate code to go with the type of activity that is being performed. Another place that you can get these activity codes is in the instructions for Schedule C, and there's a chart at the end. You can see I put a little picture there, the principal business or professional activity codes, and you can see they're, divided up into, types of activities, and then even further divided into separate codes depending on what they're doing within those types of activities. So we're still in this first section where we're just providing some general information about the business, but we're heading on down to these little check boxes. And line F is just asking the accounting method. And if you'll remember from our business part 1, the only type of accounting method that is in scope for VITA is the cash accounting method. So we do not do accrual, and there's a hybrid form of accounting method which we also don't do. The next question is asking if the taxpayer materially participated in this business, in the operation of this business. And for VITA, again, it's only in scope if the taxpayer materially participated. And to be honest, I don't think I've ever seen a client come in who was not materially participating in their business. Usually material participation means that, this taxpayer is actively engaged in, the operation of the business, or, making decisions for the business, those kinds of things. But, if you ever ran across a situation where it was kind of questionable about whether this taxpayer was materially participating, you can always look up in publication 925. There's some special tests for material participation, and so you can use that as a resource. And then we have a couple of questions about 1099s. So did the client make any payments in the tax year that would require them to file Form 1099? So a payment to a single individual of $600 or more, they need to be filing a 1099 for that individual. And then the second question is, if yes, did you or will you file those 1099s? Now, again, 1099s, as we learned in our business income part 1, this is going to be an out-of-scope return for us. So we will need to refer this person to a paid preparer if if the first answer is yes, and then it doesn't matter whether the second answer is yes or no. If they are required to file 1099s, whether they already did or whether they need to still, we're going to be referring them to a paid preparer for the year. So on to part 1, where we start to look at the income for this business. You can see line 1 is the gross receipts or sales. And for our clientele, generally speaking, the way that a Schedule C starts is they bring us a Form 1099 of some kind. Again, we looked at what types of 1099s we might be seeing in our business income part 1. So generally when we work through the flow of TaxSlayer, we're going to be going into the input screen for that 1099, and then once we finish inputting that 1099, the software cues us and says, hey, do you want to attach this to a Schedule C? And of course, if this is the first document that you've input for this Schedule C, you're going to say, yes, but I need to create a new one. So there's an option for that, and that's usually how you kind of flow into preparing this Schedule C. Now, aside from the 1099 forms, again, we have our statutory employees. They're going to have a W-2, so you'll go through the W-2 input screen, and you'll be checking the box that says this is a statutory employee. Again, TaxSlayer will cue you at the end saying, hey, why don't you attach this to a Schedule C? And so you say, thanks, I will. The kind of difference between the way the 1099s flow through the software and the statutory employees flow through the software, the 1099s usually will automatically bring over the amount that was on that 1099. The W-2 for the statutory employee, you end up entering that amount of statutory employee compensation again when you get to the Schedule C. And as always, don't forget cash, because even though a lot of our clients do come in with a 1099, a lot of our clients might be in industries where they would be getting, some sort of a cash tip, or they might be having some cash flow through certain transactions somewhere. And we need to remind them that, we're not helping them do anything under the table, and this all needs to get reported. And so, particularly again, if you're having a client come in who is from like a ride share or any other industry where tips are common, just really making sure that we ask, are you sure you didn't have any cash tips? Because those do need to be reported. They are a source of income, and you wouldn't want to be in a situation where somebody came asking about your income and you had forgotten to report something. So aside from our gross receipts and our calculation lines, a couple of other lines in this section are for returns and allowances and costs of goods sold, which again, costs of goods sold has to do with inventory. And both of those situations are out of scope. So hopefully you've kind of talked to your taxpayer before you're to the point where you're entering things into the return. Just to find out, do you have returns and allowances? Did you have inventory? If they had any of those, then they would need to see a paid preparer for the current year. So then we have our part 2, which is for expenses, and these are kind of general expenses that lots of businesses have. And we'll look a little bit closer at the particular kinds of expenses that we as VITA volunteers can help our clients with. So we're going to navigate away from the Schedule C for a minute while we look at that. Before we get into the nitty-gritty of each particular kind of expense, I want to cover this concept of ordinary and necessary. All ordinary and necessary expenses that are incurred in a self-employed taxpayer's business must be reported. An ordinary expense is one that is common and accepted in the taxpayer's industry, and a necessary expense is one that is helpful and appropriate for the taxpayer's trade or business. Now, it's important to note that that does not mean that the expense has to be indispensable to be considered necessary. Helpful and appropriate is the right term. So as we're guiding our clients through decisions about whether things are going to be deductible as business expenses, they do have some judgment over what is helpful and appropriate for their trade or business. We're just there to help guide them in making sure that that is compliant with the law, and that they're not pushing boundaries where they shouldn't be pushing boundaries. So now we can start talking about particular kinds of expenses that we as VITA volunteers are able to help our Schedule C clients with. So first of all is advertising, and that's pretty straightforward. It can include internet ads, newspapers, magazines, billboards, racing sponsors, television spots, anything to promote the business. Commissions and fees are deductible, but again, remember that for VITA, we are only looking at commissions and fees that were less than $600 per individual, per person that the business owner paid. Otherwise, it's going to be out of scope. And why is that? Well, because then if it's over that amount, they'll need to be issuing a 1099, and that is an out of scope situation for us, regardless of whether they already issued that 1099 or whether they still need to. So insurance is another business expense. So this is for business liability or property. It's important to note this is not for vehicles, a business vehicle that is taking the standard mileage rate. The cost of insurance is rolled up into that mileage rate. So you wouldn't add the insurance on top of that as an extra deduction. And then it's also important to note that this is not for the health insurance of the owner and the family. that is taken elsewhere on the return as an adjustment to income. So it does not actually show up on the Schedule C, but they do get a tax benefit for it. Interest is another business expense. This is important to note that this is for like business operating loans, or it could be the business portion of a car loan, and that can happen even when the client is taking the standard mileage deduction. So they can take the standard mileage and interest on the Schedule C, but it is not for home mortgage interest. Then there's legal and professional services. So if they paid money to a professional such as a lawyer or an accountant, but it is not if those payments were made in the process of acquiring property. That isn't an expense that gets added to the basis of that property, which if they're working with basis, it's probably going to be an out-of-scope return for us. But other types of services, professional services, could possibly be in scope for us. A tricky area with this is really kind of digging in. There can be a lot of confusion with clients about what was legal and professional services for their business versus themselves. So, you know, if it's for a will or for personal taxes, those kinds of things, then those are personal services. They're not deductible. If it was just strictly for the business, then it is deductible on the Schedule C. Then we have the office expense, and this is generally used for office supplies, things like pens, papers, postage, that kind of stuff. Rent or leases are other expenses that can be deducted on a Schedule C. Generally, you're going to see this for cars, trucks, vans, machinery, equipment. But it's important that you notice that we do have some scope issues with leasing. So any vehicle leases that were for more than 30 days, those are out of scope unless, well, it won't show up on this line, but it is possible that the client could take the standard mileage rate based on the usage of a vehicle that was leased, but they will not be having any lease expense on this line. And then we have repairs and maintenance. Another kind of little tricky area is just making sure that these are repairs and maintenance, you know, things that kind of regularly break down, wear out. These should not be for things that are considered improvements. They wouldn't greatly extend the life of whatever this is, or make it usable for a new purpose. There's tests regarding whether something is a repair or an improvement. If you have a question about something like that, you can always look up in Publication 535 for clarification. And then we also have supplies, so not just office supplies, but other general operating supplies. This one is not for inventory. Remember, in the first place, inventory is out of scope for us. But if it was something that was being purchased for inventory, it would show up in a different part of the Schedule C. Business owners can deduct taxes and licenses, but taxes and licenses do not include fines or penalties that are paid to a government for breaking the law. So, you know, for instance, if somebody receives a late penalty on some taxes, they can't deduct that late penalty. It's not deductible. Travel and meals. So this is for travel that's away from home or the metro area of the client where they generally operate. And it needs to be mainly for a business purpose. So for instance, if somebody is mainly traveling to go to a convention for their business, and then maybe they do a little bit of sightseeing, some of those expenses will be deductible. because the travel was mainly for business. If the travel was mainly for pleasure, so for instance, if they were going on a family vacation and while they're there, they happen to notice that there's a convention, they sign up for that, the travel portion of those expenses would not be deductible. They could still deduct the convention fees if they had to pay an entrance fee or a ticket, but they wouldn't be able to deduct their travel expenses. So the purpose has to mainly be for business. And then new for 21 and 22, meals at restaurants are deductible at 100%. This is different in years prior. You could only deduct 50% of meals, but with COVID, they're trying to encourage people to go out to restaurants and support that industry. Utilities are another type of business expense, but it's also important to make sure with our clients that this really was for the business and not for personal. Because we don't do the home office deduction, this is a little less of a gray area that we have to deal with. We just refer them to a paid preparer. But you know, if you see somebody that's trying to claim utilities, make sure that they have an office space that is separate from their home. So navigating back to the Schedule C, we're just under that grid where we had all those different kinds of expenses. You total those up and you have a couple of calculation lines. Well, then below that you have the expenses for the business use of your home. So this is a possibility that taxpayers could take the business use of their home as a deduction. However, for our program, that is out of scope. And so if somebody is wanting to use this deduction, then we need to refer them to a paid preparer. And then we move down the line to where we're calculating our net profit or loss. And remember, a net loss is going to be out of scope for us. So again, it's kind of important to gather all of the records of the client and you know, do a quick calculation. Most of our Schedule Cs are quite small, so you know, you're not going to be sitting there for hours trying to calculate something that's better done by software. You can usually do a pretty quick calculation to figure out whether or not they're going to be at a loss or whether they're going to be at a profit. So if net losses, we need to send them to a paid preparer. And these little check boxes down at the bottom have to do with a taxpayer having a net loss and how much they're allowed to take on their return. So then we move around to page 2 of the Schedule C, which begins with Part 3, Cost of Goods Sold, which is our inventory, and that's just going to be out of scope altogether for us. Now Part 4 is in scope for us. This is where we calculate out the mileage deduction or deduction for car and truck expenses based on the standard mileage rate. Just a reminder that the car and truck deduction is only in scope for the VITA program if the taxpayer is using that standard mileage rate. So if they're trying to use actual expenses, again, we need to let them know that they'll need to find a paid preparer for the current year if that's what they're doing. So the standard mileage rate, the IRS publishes that and updates it each year. This year it's going to be 58.5 cents per mile. And the driver or the taxpayer needs to allocate the miles between business, commuting, and other miles. So they can't just take all of the miles on that vehicle. They have to only take the business miles. Commuting and other miles are not deductible. So, and then they need to have written evidence to support this deduction. And I think for a lot of our taxpayers, they forget to keep a mileage log. And we do have some ability to help them recreate recreate that log and that support, that written evidence. We'll talk about that towards the end of this slideshow. But they do need to have that written evidence, which includes the miles and the purpose of that trip. And then the other things that we're going to need to take the car and truck expense based on the mileage rate, the standard mileage rate. We need to know when the car was placed in service. So when did they start using it for the business? And then there's a couple of extra checkbox kind of questions. So they need to check if this vehicle is available for their personal use outside of business hours. If it is, that's okay. They can still take the deduction, but it's information that the IRS wants to know. And then also they'll be answering if there is another vehicle available for personal use. A little bit more about the commuting versus business miles. This is a graphic that I pulled out of the publication 4012 just to kind of help you visualize what is a commuting mile versus what is a business mile. So commuting miles are generally, to and from your home to your work. So, when you go from home to work at the beginning of the day, that's your commute. And when you come home from work to your home, that's also part of your commute, and that's not deductible. However, some of our clients might be going to several locations during the day. They might not just have one place of business, in which case it gets a little more complicated. But generally speaking, the mileage from their home to the first place that they go is considered a commute. And then when they travel from that first place of business to a second place of business, that can be a business mile. And then whatever they do during the day, between work locations, but when they go to their last location, their last stop, and to their home, that would be considered a commuting mile. And this can get a little bit tricky with our taxpayers that are doing delivery services or ride-sharing services. So wherever they are located, if they're located at home, to that first location, that's going to be commuting. And then when they pick up their person who's riding and take them to wherever, then that begins the business mile and miles. And then when they're heading back home, then it becomes a commute again. So the last part of our Schedule C is just a generic other expenses part, and you can see there's a little line there for an explanation, and then line for the monetary amount. And again, just because whatever expense they had was not specifically listed before, if it's ordinary and necessary for their business, they're still going to deduct it. And so this is the space where they would do that. So a couple of expenses that could end up in this other expense area are things like education. Now, in order to be able to deduct education on the Schedule C, it needs to be something that is for the business. And so it would be a type of education that would maintain or improve the job skills of the taxpayer. And then it could be something that's required by law or regulation. So if they're in an industry that requires some sort of certification or so many training hours per period of time, those would be deductible as education expenses on the Schedule C. Another type of other expense we talked about a little bit in our business income part 1 lesson, and that's the safe harbor de minimis. And if you'll remember, that's for personal property items that generally without this de minimis would need to be depreciated over time. But the de minimis allows businesses, so long as it's part of their regular accounting procedures, to expense items that are, if the item or the invoice is less than $2,500 each, or if they have a different policy that's a lower amount, then they would be expensing that lower amount. And then they would need to attach a statement saying that this is the safe harbor de minimis in order to expense this item. So let's talk a little bit about record keeping. This can be a real challenge for some of our clients. A lot, especially because we'll have clients come in and maybe for the first time this year, my examples are always the ride share and the delivery, but that's the one that I tend to see most often, where people, they maybe want a little extra income, or they got laid off and they want to try this for a little bit, and they don't really realize that they are now needing to keep records, and they're going to be filing the Schedule C as a business. And another instance is sometimes people are surprised when whoever they're working for treats them like a contractor as opposed to an employee, or they don't understand that there's a difference between filing your taxes as an employee versus filing your taxes when you're an independent contractor. So a lot of times we're catching people on their first go at this, and so they didn't realize that they should have been keeping records. And so we do a lot of, education about what they need to keep, why they should keep it, and sometimes helping them to recreate those records. So it's a good idea to just talk about the benefits and why we need to do this record keeping. First of all, you end up talking to them about, oh, this is, independent contracting income. The person that you're working for is not withholding taxes, but then you also get to deduct some expenses. And so if you want to owe fewer taxes, you really want to keep track of this stuff. So we talk about monitoring the progress of their business, preparing financial statements if they ever want to get outside funding to grow their business. That could be an important reason to keep your records. They might need to identify the source of receipts. They definitely are going to want to keep track of those deductible expenses. And it helps with preparing the tax returns. And if they've kept good records during the year, little bit by little bit, it makes the tax return process a lot more friendly. And then, of course, supporting the items that are reported on tax returns. The worst is to have the IRS come back and say, well, wait a minute, what's happening here? And then you didn't have record of it. It's much easier to just, if the IRS sent a letter, be able to mail back whatever proof that you have, and that just makes it an open and shut case instead of dragging on and being incredibly stressful. There is flexibility with what kinds of specific records people can keep. There's a few cases, like with the mileage, the IRS wants to see some specific things in order for something to be good support for that deduction. But there's not necessarily that detailed of guidance for everything. So taxpayers can choose any record keeping system that suits their business as long as it clearly shows their income and expenses. So the things that they'll probably be wanting is a summary of the business transactions. So a lot of the really small businesses, it just ends up being, their business checkbook. If they're a little bit bigger and a little more comfortable with technology, maybe they're keeping accounting journals and ledgers in some sort of an accounting system. And then for supporting documents, they can keep sales slips, paid bills, invoices, receipts, deposit slips, canceled checks, are all generally good supporting documents. Again, for mileage, we want our taxpayers keeping a log of, you know, the days and the times and the reason that they were traveling for business, and then the mileage as well. And as I mentioned, we fairly often see taxpayers come in that didn't realize that they should have been keeping records, and so we are there to help them understand what kind of reconstruction they can do and should do to be able to support what's happening on their tax returns. So the goal of the record reconstruction is to use what documentation the client does have, and kind of work with that to develop a sound and reasonable estimate of what the taxpayer's business income and expenses were. So our job as volunteers is to, you know, make adequate inquiries. So if you're, first of all, if they come in and they just don't have any records and they're, you know, just saying round numbers, we talked about that in our business income lesson 1, that's kind of a red flag return for us. And so we really want to be probing to see, well, you know, do you have any record of that? That's a round number. It's kind of unusual. Can you talk to me about how you charge your customers? Can you talk to me about, you know, who are your regular customers? You know, can we maybe use, you know, your appointment books and figure out, you know, what days this would have come in, you know, do you have bank records, those kinds of things. It's our job to probe adequately enough that we're doing our due diligence, that we're not just, you know, preparing something that's so wildly unbelievable that, you know, it's just unreasonable to prepare that kind of a return and file it. So once we've made adequate inquiries and we're kind of figuring out what the taxpayer is going to need in order to support their Schedule C deductions, income and deductions, we can help with some simple reconstruction. Again, this really commonly happens with the clients that come in that maybe they did a little bit of ride share for a month or two and then it didn't work out. And so, you know, we can use the apps, and they've maybe only done a few rides, and we can look up on Google Maps or a map app and figure out how many miles they went. And, you know, usually they'll kind of have an idea about what they were doing. And the app really helps with that. If it's going to be more complicated, which does happen, we aren't really set up in a way to create extensive reconstruction. So we might let them know, here's what records you need to pull together. Let's reschedule when you get, and you work on getting those together, and then we can get your return prepared. If it seems like it's going to be beyond what a non-expert is going to be able to do, then we can also just say, you know, this year might be a good year to see a paid preparer to help you kind of get yourself organized, and then maybe in another year we can do your return for free. And here's a little more extensive list of the kinds of tools that we can use to help figure out what the income and expenses for the Schedule C were. So if the client is keeping appointment books or calendars, you know, again, that helps with, you know, what was the purpose of the mileage, you know, what was happening, what was the business reason for this. Online map tools, the IRS standard allowances. So, you know, again, just like with car and truck expenses, you know, if people aren't keeping receipts, well, that's fine as long as you can figure out how many business miles you had. You can take the standard allowance for mileage. And then checkbooks and canceled checks. Banking apps are really helpful. A lot of times we have to pull those up, or our clients need to pull those up and see, oh wait, when did that income come in? Cash apps and accounting software. There are free accounting apps online, and apps where clients can take pictures of their receipts, and that app will just store that picture. So that's really helpful. There's a lot of tools that way that you know, and usually our clients have their phones with them, so we can say, hey, why don't you search up, you know, for an accounting app, and let's see if we can get you set up with something. And again, there's lots of free options. And then there's bank or credit card statements, lists of regular clients, partial receipts or sales tax records. So, you know, if everything can't be found to the last penny, you know, are we getting pretty close to where we're, you know, what we're filing largely is representative of what was happening. And then the cell phone records, call history, computer logs, and prior year returns. Whew. So now that we've been through the entire business income lesson, so we had part 1 in the last video, and this was part 2, you should be ready to help clients with and file, you know, a lot of the more simple kinds of Schedule C returns that we see. Certainly, you know, there's a lot of material here, and, you know, if you can't memorize it all, really don't feel bad about yourself. We have our resources there for a reason, so we can look stuff up. I certainly don't memorize everything. I look stuff up, and I tell my clients, hey, you know, I just really want to be sure that I am treating your tax return and the things that are happening on your tax return as accurately as possible. And the clients are very responsive to that. They don't mind at all. They're willing to spend a little time to make sure that things get done correctly. So if you have to look stuff up, that is okay. So now you're ready to go on to Lincoln Learn and answer the skill check questions. There's just 2 of them. If you are an Accounting 496 student, instead of going on to the Lincoln Learn website, in Canvas you'll have a quiz that's 10 questions. So that's what you'll be doing. And then in TaxSlayer, we have a practice return that has a Schedule C, so you can go ahead and practice with that in TaxSlayer. And as I mentioned before, we have our resources, so Publication 4012 and 4491. Any of the IRS publications you can use. You don't have to just use Publication 4012, even though that one's specifically for the VITA program. And it's very, very helpful. Sometimes you might want to use some of those other publications for more specific and detailed guidance. So that's all for now. In our next lesson, we're going to be talking about some advanced adjustments to income. So we'll talk then.